raised. He sold 20% of the business for $1 million to around 50 investors. And so imagine the return on that today for that $1 million for 20% of Amazon. It's more than he still controls to this day, for context. And he took that to buy the initial inventory, get the website established, hire the first developers to get this going. And so if you're going to take on financial debt, use other people's money into your business. If you have a market that must be captured quickly in order to get a network effect of some sort, or you have huge amounts of capital that are required to make the business start to begin with. So if I wanted to start, call it a pharmaceutical business, then I would probably have to have capital for an extended period of time to start a new drug, to do the research, and then maybe 5 years after we get the licensing, then have the ability to print money. But that capital would have to come from somewhere. And so unless you start as a billionaire to begin with, which you absolutely could do that, hypothetically, but the vast majority of these businesses are not started by billionaires. They're started by everyday people who have a good idea. And then they go to people who have capital and say, hey, I will give you a piece of this upside. Now, this is the live fast, die hard style of making money. The reason it is that way is because it will typically be very investor favorable, especially the earlier it is, because they are taking on more risk. And so the big thing about these mega wealthy paths is that the underlying thing that occurs in all of this is, one, return on invested capital, and two, the risk that you're taking in order to validate or justify that return. So some guy in 1995 says he's going to start a bookstore on the internet, whatever that is, and you give him $1 million, it's like, I need 20% of this thing at least, because no one's ever done this before. You've never started a business before. What's the internet? And are people even going to buy stuff on it, right? So there are so many unknowns here that it makes sense that they had a tremendous amount of compensation for the veritable guarantee that they would lose the money they were going to give. And that's probably part of the reason that Jeff Bezos didn't just raise it from his friends and family, despite the fact he was a Wall Street insider. So he could have easily gotten the $1 million from probably a handful of people, but he also probably knew that there was a very low chance of success, which I think he says in his early interviews. He figured that there was a low chance of actually making this work. And so when you follow this path, the other people's money into your business path, there's really only two big kind of potential outcomes. One is, as a founder, you're going to de-risk along the way, which means that sometimes you will get something called secondary. So when an investor puts money into a business, they're going to appraise the business based on how quickly it's growing, how likely it is to continue to occur, and well, for them, the ease of investment is high because they just have to make the investment, but still the fundamental value equation exists for them as an investor, where your business is the product itself. And so let's say that we have a business before the money that is worth, we'll call it $10 million. And then they say, I want to put $2 million into your business. So if they put $2 million into your business, this business is now a $12 million business where they now own 20%, and then everyone else now owns 80%. And so the founders, the original shareholders, are going to get diluted. It means that they now own a smaller percentage, but now the business has more capital that can help it grow. Now, a different path to this, if instead of putting $2 million into the business, they could have put, let's say, $1 million into the business and say, we're going to pay the founder over here into his personal bank account $1 million. And so that's called secondary. And then most people don't even say primary, but it's kind of almost assumed that money is going into the business when you're raising a round of funding. And so some founders will de-risk along the way, because at some point, when you have a $1 billion asset and you have $100,000 in your bank account, some investors will understand that the founder themselves will become a little bit volatile. And so they want to give them a little bit of money so that they're not constantly freaking out and actually can make better quality decisions. So it's not uncommon for founders to take a little bit of chips off the